Good evening. Thank you everyone for being here. Great to have a nice crowd, and I think people are still walking in, so it's great. We have an amazing pair of speakers here tonight. So I'm not going to get into the way, but I've quickly introduced myself. I'm the Vice President of the Roundtable. We have a few management committee members and officers here, so anyone who's not a member, please look for the yellow name tags. Come reach out. We'd love to have new members join us at the Roundtable. The New York Alternative Investment Roundtable is an industry nonprofit that hosts monthly events and promote industry best practices, among other things. And it's a great networking place. We have great people that are members here. Thank you to our sponsors. They've been very supportive over the years from various aspects of the industry. Press isn't present here tonight, so I want to make sure everyone knows that there's press here tonight. I'm reading from my phone because I didn't want to print some paper that I wrote the notes in. Please make sure that you silence your phones, and while the session is ongoing. We have two amazing speakers here, Gary Brode and Mark Rossano. Gary is a managing partner and founder of Deep Knowledge Investing, which provides high alpha, deeply researched stock ideas and timely market commentary to hedge fund managers, portfolio managers, family offices, and high net worth individuals. He has more than 30 years of experience in the securities industry. Gary, thank you for being here. And Mark Rossano is a financial industry veteran and renowned expert on global financial markets and supply chain analyses. As the founder and CEO of C6 Capital Holdings, he provides investment and consulting services to clients across multiple sectors, with a pronounced focus on global product flows. As an expert in supply chains, he serves as a consulting executive to several international businesses and is an equity partner in several others. So without further ado, Gary and Mark, please take this over. Thanks for being here.
All right, thank you.
Thanks for having us.
Yeah, thank you so much, and thanks to BJ for the invitation. We're really excited to be here. Mark, I want to start with the question that's on everybody's mind. The biggest story this year has been inflation and interest rates. My firm, Deep Knowledge Investing, came out in November last year and said inflation is hugely understated. It's enormous. It is not transitory. It's a serious problem. On our end, we've been saying that it is a continued issue. It is hugely undercounted. And we're being countered in the media, on Twitter, in public by what I call the pivot people, right? Every time we get a piece of economic news that isn't glowing, we have all these people yelling, the Fed's gonna pivot. They're gonna pivot. It's gonna stop. The market's gonna go up. And everybody's very excited because the sooner we get rates up, the sooner we can get rates down and start start the zero interest rate quantitative easing infinity party started again, because that's how things should be, right? And so I see this all the time. The pivot is coming. Where are you on this? Are you a pivot person?
I'm not a pivot person. So we'll try to not get too depressing, I promise, but we will try to be open about some of the things that we're seeing. And it's funny when you talk about the inflation side, and the Financial Times had hosted an event back in 2014, and the managing editor got up there and said, I'm going to show you why inflation's alive. And she puts together all this math, and she said, and now you can see how inflation is actually at 6%. And when you go back in time and you look at the 1982 adjustment in the way they calculated inflation, then how they did it during the 90s on the switch over to owner's equivalent rent versus others, you can see how they keep trying to hide it, keep trying to pivot and say, oh, well, no, inflation isn't that bad. Or look at the velocity of money. The velocity of money is really low, so it's fine. We can continue to do this. And we really relied on cheap energy for so long, and that was how we were able to disguise the inflation rates that we were really facing. Because for anyone that has kids that pays for their own health care, you can attest that 2%, 1.5% was probably a little low for what you were actually experiencing at the house. And now, with the, let's just say, the advent of COVID, or from the before times to the now times, you can see.
Advent or invention?
Yeah, exactly, the invention of it all. So when you look at the shift in terms of what central banks had done, now instead of just having some guise of monetary policy, the monetary side, the fiscal side, just unleashed all of this paper into the market, and they blew away any type of hiding the inflationary story. And one of the things that we've come out and said was that this decade was going to be a weird amalgamation of the 70s and 30s. And when you look at what has happened after this point, we're going to have this weird 70s shortage when you look at just supply. Like and wanted to steal a quote from a friend of mine, we're short molecules. And we're short molecules in so many different ways, from electrons to oil to natural gas. And even as demand is falling, you still have this weird backdrop because supply is trying to fight its way down, which is why when everyone looks at this pivot and they look at this, oh, inflation, it's going down this time, I can see it. And it's like, but where? Like, food is short, where fertilizer is short. You have European products shutting down. Where are we going to get this pivot? And that's why I always laugh when everyone talks about the shift lower in inflation, where the disguise is gone.
Right, and so I actually want to add to what you're saying. One of the things that people have a misconception about, right? We get the CPI quick. What does that represent? Inflation. You guys know that, right? The CPI is inflation. No, it is not. The CPI is a government manufactured number designed to advance a narrative, right? And this is what Mark was just talking about. So because I'm a really boring person, I'm going to talk to you guys about statistics, because who comes out on a Thursday night and doesn't want to talk about statistics, right? So first of all, Mark's talking about, they're saying 2% inflation. We know, right? The Fed says 2% is our goal. Now, that seems kind of reasonable. 2% isn't a lot, right? Like, if I asked any of you guys for like 2% of what's in your pocket right now, you'd be like, all right, whatever. Yeah, go buy a coffee. No big deal, right? But let's say you have a 40-year working life. Over the course of 40 years, 2% inflation, your purchasing power will be cut in half. This is theft. This is not minor, right? Because compounding, you guys all understand compounding or you wouldn't be in this room. Next, what Mark is talking about is the change, the way these people try to hide this. So back in the late 90s during the Clinton administration, they switched from the calculation of actual rent cost or actual housing cost to owner's equivalent rent. And they basically go to people and say, if you were to rent out your house, what would it rent for? Nobody knows. When was the last time you guys thought about renting your, right, exactly. Nobody's thought about it. So you get these really weird charts. And if you check the Case-Shiller index, it looks like this, and owner's equivalent rent looks like this, right? And so let's take a look and just do the calculation like they did back in the 1970s. Remember the bad days where Volcker had to come save us, and they were saying, we had inflation in the mid-teens, and they had to raise rates to the high teens. If we were to calculate inflation today, the way they did it back then, you're looking at inflation in the mid-teens, okay? Now you start to put those numbers across a 40-year working life, and we're talking about obliteration of your fiat currency. This is absolutely, Mark said he wasn't going to depress you. I don't care. I'm not here to make anyone happy. What we are talking about is the obliteration of fiat currency. And if you guys think that won't affect, forget the financial markets, the society you live in, when the value of your currency is changing by 15%, compounded year over year, that'll completely change the society we live in. And, I might recommend that we start thinking about the way we're investing with this in mind.
And some of the key things when you start looking at the owner equivalent rent and why you had that slowdown in terms of this catch up. So if you are someone who rents property and you don't know if you're going to get rent, because if you remember, there was a moratorium on evictions, people wouldn't pay rent. So if you say, and there's an option to say NA, because you don't know. And in order to keep the calculation simple, they put that as rent to zero. So when you go through the 2020 numbers, everything was depressed, and you're like, I know that's wrong. Like, I know for a fact that, and now you're getting this big catch up. So when you look at the catch up overall and how this is pivoting, the big thing that Powell is going to focus on coming back to the 70s. So if you look from 1970 to 1974, you had this big inflationary spike, started to raise rates, try to get in front of it. Then you had inflation falling, and this is the fun thing about base effect, where they assumed, inflation is falling, we got ahead of it, It's at 4.9%. We're projecting it's going to be at 3%. It's time to pivot. And what did they do? They pivoted. And that created this robust, just massive wage spiral, which is something that we don't want to have. My business partner, who is Brazilian, can talk about what a wage spiral looks like and what adjustments on a month-to-month basis on salaries look like. So when you look at what happened from 76 straight through to 82, when Volcker tried to get in front of it, was to break the wage spiral. So when you look at what the Fed is trying to do to protect fiat, to protect that backdrop, is raise rates to a point where they can stay in front of the wage spiral, they can stop that from happening and try to protect what we've essentially taken advantage of for the last, since the first Bretton Woods, where we are the reserve currency. So how do you maintain that? We have the strongest Navy in the world. Usually, historically speaking, the largest Navy is the reserve currency that will stand, and trying to stay in front of it. But by doing that, it's not, and we can talk about the dollar and rates, everyone looks at the dollar and says, oh, well, the dollar's high because the Fed is hawkish. It's like, well, are they hawkish, or is it everyone else is so bad right now that even if the Fed were to pivot, this famous pivot, it's like, oh, the dollar's going to go down. Have you looked at the ECB? The ECB their balance sheet is 81% of GDP. Since this all started, they've reduced their balance sheet by 57 billion as the country implodes. They essentially have what's my favorite, the anti-fragmentation tool, where essentially they're pitting QT on Germany and QE on Italy, and with Italy having 137% of debt to GDP. So now with Germany, which is having its own issues with its own right, they're only at 37% of debt to GDP. So when you start looking at these backdrops and these shifts, is the euro going down because the dollar's exploding, or is this happening? Then you turn over to Asia and you look, and we were talking at about 3:30 in the morning,
Something like that, yeah.
because we got these alerts at 12:30 a.m. that the yen with the debt had blown through the yield control curve. And all of a sudden there was this panic, and the BOJ announced instant buying because they were trying to bring this back down. It's like, don't you understand how the market works? Everybody in this room is sitting there going, I know you're going to blink, and I'm going to keep pressing it until you blink. And I know you're going to. They did it with the BOE. They're doing it with the euro, and the yen is the last one. When you look at the yen to dollar ratio, is at the place it hasn't been since 1990. So there's something there.
Yeah, I want to jump in on that value of the dollar point. And by the way, what Mark said is true. He sent me a message private message on Twitter at 2:30 in the morning, which I read at 3:30 in the morning. So you guys figure out which one of us is the idiot. But one of the things that we've been writing at Deep Knowledge Investing all year is about inflation. And let's just take a step back, because everybody thinks about inflation as, it's a good thing, it's a bad thing, it's a thing that's happening. But what it really represents is a loss of purchasing power, okay? And what Mark is talking about is the huge strength in the dollar against these other currencies. And so I've been getting these questions, wait a minute, you're telling us that the dollar is getting weaker, you're losing purchasing power, the dollar's doing great, the dollar's at all-time highs, and so here's the thing, you need to have two thoughts in your head at the same time. And so ask yourself, right, are you thinking, if you're a foreign exchange trader, the dollar's doing great, and it's because of exactly what you said, the other central banks are just behind our central bank. That's kind of a weird thing to say, they're just more slow than our guys are slow. Okay, fair enough. So, but if you're an American consumer and you want to buy things like, I don't know, food, fuel, shelter, which is the fancy name for housing, right? Your dollar isn't going anywhere near as far, right? The CPI, the Bureau of Labor Statistics, they can tell you that housing is up 5%, 6%. It's not. You guys know it's 20% year over year the last couple of years, right? They're trying to tell us that food inflation is 10, 11%. Has anyone in this room been in the supermarket in the last year? Do you believe that number? Raise your hand if you believe that number. No one. All right. So the point is, and you need to have these two thoughts in your head at the same time. If you're a foreign exchange trader and you want to buy euros, the dollar is incredibly strong. If you're an American consumer and you want to buy food, shelter, and gas for your car, right? The dollar is getting weaker month over month, right? And that's the key thing. So just ask yourself, do you want to buy euros or do you want to buy food? Either is fine, but no.
And that's when you start looking at rate differentials, when you start looking at how we sit between other rates, other bonds, and that's when you can start to see the weakness around the world. And it's funny because and this is the consumer actually recognizing, my mother took me out for my birthday in August, and she sits me down and she goes, "Did you see what happened with eggs?" I was like, what happened with eggs? She's like, "They're $4.99. She's like, "Did we kill the chickens?"
Yes.
And I was like, well, yes, we're trying to feed people, but it's noticeable now. And again, we're not in a position where she's not gonna buy eggs, but there are people out there that is a real decision. When you start compounding all of these pieces in terms of eggs, milk, all of these pieces that you just need for basic living, and if you look at food, and this is where it's fun, because the other thing that the Fed likes to do is like, well, this is CPI minus this, and this, and so then you get this number. It's like, wait, don't I need those things? So when you look,
hang on, that's actually like being in second grade and you take a test and the teacher tells you got a 7, you're like, hold on, let's just take these answers I got wrong. We're gonna take them out of the test. I really got a 95, right?
That's perfect.
It works.
And it's funny because when you start looking at the things that matter most, when you look at food, when you look at fuel, now when you look at electricity prices, as you see all these things coming up, it's actually closer to 17%, 19% when you start taking away. And now the other piece that I always like to talk about is sticky inflation versus flexible inflation. Because everyone likes to point to flexible, and I'm sure you have heard, Biden yelling about bringing down gasoline prices. What are you guys doing? Gasoline should be lower. It's like, well, let's break this down and let's look at where flexible inflation is versus sticky inflation. So flexible inflation has fallen 13%, and it's still higher than it was in the 70s. And then you look at sticky inflation, which is services, which are things that are starting to come back. And we talked about rent. We've talked about housing. That continues to go up. But then you look at wages. Are wages keeping pace? So then there's a fun chart of, as you talked about the price Schiller, the Schiller levels. But then look at wages and where are wages and how are you going to afford that gap? Are you going to either increase wages or you're going to have to bring down asset prices? And that's where we sit right now of how do we bring down asset prices? And then we'll have the fun of talking about the UN and how the UN is saying that this is the worst policy decisions ever. We need to cut rates. And so, was buying mortgage-backed securities, which is legal or illegal?
Illegal. $2.6 trillion of illegal securities being held by our Federal Reserve. They are not allowed to hold those, right? And $2.6 trillion is real money. And so for everybody saying, oh my God, what's going on in the mortgage market? It's a manipulated market.
And they did this during the largest appreciation of home prices in our history. So was that the poor policy decision or what they're doing right now? When you look at since the Greenspan view of keep rates low forever to the Bernanke of saying the BOJ got it right, and then continuing that for over a decade, that wasn't a bad policy decision, but actually trying to correct poor policy decisions is the problem. And that's where we continue to go back and forth on where we sit today.
Yeah, and regarding the United Nations, I don't know if you guys saw it last week, but the United Nations Department of Trade and Development, which apparently is staffed by Keynesian economists, actually came out and they said they wanted all the developed nations to stop raising rates, to go back to zero rates, to start the money printers again, and, ready for this one, implement price controls. Okay, let's think that through for a minute. So we're going to have tons of currency printing and zero interest rates and price controls. What happens to supply? Nobody's going to make a thing. And where that leads is to excessive amounts of human misery. So I'm not sure what the goal of the United Nations is, but I assure you that that path leads to shortages of food, clothing, fuel, shelter, everything. And it's mass starvation across the board. And this is what these people are suggesting. And in a piece that we released earlier this week, I actually suggested that we replace those people at the United Nations with a hamster. And I am in no way suggesting that a hamster would do the job well, just better than the people who do it now.
And that's when you start looking to what is causing this. And that's getting to the other piece of the geopolitical sphere, and everyone thinks, well, blame Russia. Russia's doing this, it's Russia's fault, Putin did this. But then if you go back through time prior to the invasion, by no means saying that the invasion made it better, but we were on this path. And when you look at food and how the food issues really began in earnest in 2009 with the shortage of fish, with the issues that started to rise. And for those that remember, depending on where you were at the time, it was either the Arab Spring, it was the peasant uprising, it was the wheat wars, which kicked off in 2011 in Syria, still ongoing. Egypt, you had two changes in the underlying administration, but we never fixed the issue. And if you look at yields in general, so yields have flatlined since 2012. And we have not been able to appreciate past that on a global level when you look at the shortages that have been created from the fishing side. Then it's like, all right, well, we now need to rely more on wheat and rice and soybeans. And it's like, okay, well, last time I checked, there's a lot of new shifts in weather patterns. We have droughts over here. We're increasing the amount of livestock we're raising, which is increasing the prevalence of bird flu, of swine flu. So the issues were starting, and now you have Russia invading, and you're taking 26% of grains from Ukraine out of the market. You're taking potash out of the market. You're increasing the price of natural gas going into Europe, and then Europe turns around and waves the flag that we succeeded. We have natural gas storage where it needs to be. It's like you shut down 70% of your economy to achieve that storage. What happens when you turn it back on? What happens when your farmers need fertilizer and you said, oh, I shut down all the urea. Did you need that? And it's like, well, yes. And that's where you continue to see this compounding piece. And obviously, given what Putin is doing, it's unlikely we're going to see a pivot. But then you look at India. India's a net that they export excess wheat. They've now put gates up. They export excess rice. They've now put gates up because they want to ensure they have enough food at home. And what is that going to do to the ASEAN nations? What is that going to do to Southeast Asia, which rely on these grains, on these foodstuffs to survive?
Right, and for anybody, the key point on what Mark was just saying is look what they had to do to their economy. So if any of you are invested in Europe, just think about this for a moment. In order to save fuel, Germany has shut down their steelmaking capacity. They've shut down their industrial plants. On top of that, so we all have seen what happened in the United States when, during COVID, we printed trillions and trillions and trillions of dollars of currency and just flooded the market, while at the same time discouraging people from supply, right? More money, chasing fewer goods, we get inflation. Okay, but here's what's going to happen. Europe did the same thing, and now they're saying, the government is saying, we're going to cover the cost of excess fuel for the winter. Now, the estimates I've seen are 5 to 10% of EU GDP. Okay, do they have that? Does anyone have that in the bank? They don't. So how are they going to do it? They're going to print euros. So they're going to do all of this again, inflating their currency or devaluing their currency rather, while shutting down their steel plants, shutting down their industrial production. They are looking at a massive recession coming, or possibly depression, right? It is going to be a long, hard winter there, and not just because of the fuel. They're shutting down their industrial capacity. On the food side of things, Mark is completely right. It's very fashionable to blame Russia for everything, and yeah, there are certainly issues with fertilizer and with wheat that he's talking about, but look at what's happened in the United States. I don't know if you guys know, but this year we had a horrible bout of H1N1 avian flu go through our flocks. And the protocol, for understandable reasons, is if one chicken tests positive, they kill the whole flock. That was tens of millions of birds that were killed on that. We had a drought in the Southwest. Ranchers, they wiped out their entire herds. They took their entire herds to slaughter. So if you're looking at beef prices right now and you're saying, wait, this isn't so bad, it's not, because the ranchers took their entire herd to slaughter, but what happens next spring? You need cattle to make more cattle. They can't just start a plant, right? So shortages are coming, and there are going to be shortages all over the place, and food is the primary place that I would suggest that everybody, like, shore up your portfolio, shore up your homes.
And when you look at, picking up on the Germany piece, Germany is a net exporter. So they typically have a positive account balance. And when you look going back to 1949, they're not negative. This is the first time that this is the lowest it's ever been. And it's a mixture of, to Gary's point, in terms of where things are going and what that looks like. Their costs are rising, import costs are rising. They're shutting down all of these key pieces from smelting to steel. But where are they getting the coal? Where are they getting the electricity? And now, okay, so you start to turn things back on because you shut down the economy. Well, who are you calling for LNG? Where are you getting your gas? And now that's when you start looking at the natural gas side. And China has just announced that they will no longer resell the gas to Europe, which is how they were able to achieve this, because China just made money on it, said resell it. That is now gone. So when you start looking at the waking up from, hey, we need to turn this back on. The farmers need stuff. We need to get this going because Germany is the growth engine. It's not there. Now you look at Japan. Japan is another key growth area. You look at South Korea, another key growth area from the export side. They have a record amount of inventory when you start looking at the tech piece, when you start looking at all these key components, because that is the end of the bullwhip. For those that have heard that mentioned many times, you're seeing these issues coming around, but even as these inventories are building, you're still getting inflation higher. You're still getting all of these issues. And then as we near shore and onshore, the new famous thing, if you remember the 60s through the 80s, we exported inflation, we imported deflation. Now we're doing the exact opposite. We are now importing inflation for reasons that we discussed earlier, supply chains, trying to shore things up, but it costs more to do things here. And what about input costs? We talked about CPI. What about PPI, the producer price index, the key input side of how people come up with their prices? That continues to be elevated and sticky, but where is it coming down from? What new source of energy are we going to distribute that is going to bring that price down so manufacturing actually is a deflationary cycle again?
Someone who's talked about that, whose work I really like, and if anyone doesn't read Lynn Alden, I suggest that you do. But she wrote a piece earlier this year on how one of the reasons we had this great 40-year cycle of things getting cheaper is because of what Mark was talking about, that we basically took expensive onshore manufacturing and we sent that overseas. And we were able to do this at a time of just-in-time inventory, leaner production, costs came down, and we really had, for a large extent of that 40 years, global peace. And now everybody's realized, wait a minute, supply lines are way too fragile. And there are certain things we need to bring onshore. I'm going to start with pharmaceuticals and semiconductors, right? Does anyone want to rely on China for the chips we need for missile guidance systems? I don't. Do you want to rely on China for your pharmaceuticals? I mean, 90% of our pharmaceuticals. I don't. So unless you want to rely on China for your chips, for your pharmaceuticals, right? And hopefully the people in this room aren't taking a lot of pharmaceuticals, but grandma might need something, right? These are national security issues. These are quality of life issues. So our only option is going to be to bring that production from inexpensive places that are becoming more hostile and bring them to places that are more expensive. And if COVID taught us anything, it's that this just-in-time inventory trend, that was great, but supply lines are going to need to be more robust. And so everything has to be more expensive if you want to have delivery.
And the other little things when you start looking at heparin. So heparin, a key anticoagulant, most people take it after surgery, is actually made using pigs intestines. Well, what happens if you don't have enough swine? What happens if you have a lot of it going away? A lot of that is made in India, and they couldn't source. So there was, if you dig through the archives in 2020, they talked about how India, we had to assess how much storage do we have of heparin. because there was a concern that hospitals were going to run out. And as we all know, there was a lot of issues with hospitals in 2020 that we had to address. So there's so many knock-on effects, and the way the world is connected is so intricate, where when you start looking at this reshoring adjustments, it's like, okay, well, we started moving clothing from China, it was Indonesia, it was Vietnam, Bangladesh. But the things that we're talking about moving now, the battery manufacturing, the semiconductors, the assembly of phones, that takes a ton of juice. You're talking about an electrical grid, and you just look at the US, we've watched it start to break down in Europe. When you look at the grid in general, it's like, okay, well, you're taking down baseload capacity because you're telling me coal is evil, you're saying that natural gas is bad, and you're telling me that you want me to build solar and wind. It's like, okay, well, that sounds great, but this doesn't produce all the time because the sun goes down, the wind doesn't blow, so I need baseload. But then when you do your estimates, you're going to tell me that these have no variable cost. Well, it's like, but I have to turn on the short cycle gas to do that. So you're taking down your baseload, the piece that you need consistently, and you're increasing your demand because you're telling me that I have to buy an EV, I need superchargers, I can no longer connect to natural gas in my home, so I need electric heat, electric stove, electric dryer. But you're going to increase my cost because you're taking down the base load that was backing it up. And now when I look at the natural gas and the coal side, coal is at the highest it's ever been in the Midwest. You will show me the last time a coal mine came online in the US. We have the lowest coverage ratio ever in the United States for coal inventories. Oh, and then the nuclear side, all of our nuclear, all of that backlog that we have, which we normally have a year's worth of inventory, we have 8 months and 40% of it came from Russia. So when you start looking at how sensitive we're getting, but we're going to bring battery and we're going to build battery facilities that suck all of these gigawatts on what grid? We've watched the UK break, we've watched Germany break, we've watched France break, and now France, which was my favorite, Macron spent, and the government spent the last 20 years talking about how nuclear was evil, and now all of a sudden it is now green. Though I think we can argue it was always green, but you're looking at these pivots but you have to maintain them. Well, did you maintain them for 10 years when you told me I was going to decommission it last year? And the answer is no. So now you have this catch up. Oh, and where did Europe get all of the nuclear fuel? Russia.
Yeah, and one of the things we've talked about a lot is exactly that point where everybody thinks we're going to have electric cars and battery and the electrification of everything. Where are we building that capacity? And like we were talking about this earlier today, just think this through for a little thought experiment. Tomorrow morning, hypothetically, a group of very wealthy, very powerful people come out and they say, we're taking this seriously. We want to start building great capacity, right? Because we need that. We need that for all the things that we want to do. Anyone want to guess how long that permitting is going to take? Right? I guarantee you it's not done by 2035 when California thinks they're going all electric, right? So, and other things too that Mark was talking about, but I want to just say it in a sentence. You have no idea how much water and energy is used to make an iPhone. Those fab plants, if we're going to bring them home, we need a lot of water. We need a lot of energy. Lithium mining, that's a lot of diesel. It's a lot of water, right? It's a lot of environmental remediation. So these things aren't free just because we don't have them in our backyard, and a lot of people aren't thinking about that. Mark, I want to switch the conversation for a minute because I love talking about policy silliness, and I want to get back to that. So we saw a couple weeks ago the Bank of England bailing out, yeah, I know, it's funny already. They're bailing out their pension funds who leverage themselves up figuring we can't make money to pay for the pensions at 0% rates. So they leveraged up thinking, well, we'll have 0 rates forever. And then when it turns out that they didn't have 0 rates forever, they were leveraged short the wrong end of the curve. And so their pensions were this close to going under. The Bank of England comes in and they say, okay, we're providing a market for our 30-year gilt, which is their long-term treasury, their equivalent. And, we're joking about it. Okay, so we've got higher interest rates, quantitative tightening and quantitative easing all at the same time, and it was fun to make fun of the British for 10 minutes. But last week, our Treasury Department actually asked our banks if they wanted the Treasury Department to provide more liquidity on the long end of our bonds here. And I'm thinking to myself, okay, so wait a minute. First of all, that's raising rates, quantitative easing, and quantitative tightening at the same time. The second, because for me, everything comes back to the second grade, asking a bunch of bankers if they want more liquidity is like asking second graders if they want more candy. Like, of course they do, but why? Why are we doing this? You know?
So it's funny when you look at how they position themselves. So if you go back to Greenspan and beyond in terms of bringing rates lower, it's like, okay, well, now I'm a pension fund. I'm either going to tell my constituents, oh, by the way, you were expecting 4% to 5% increases per year. It's really 1%, so deal with it. Or let's increase the risk. Let's get risky because we need to go out there and maintain. So let's go buy Nigerian debt. Let's go buy Indian debt. Let's go buy and go up the risk scale instead of having that risk-free rate. So when you look at the underlying structures, now you have these countries that are severely levered, and they're levered to a point of countries that are going to be hit by the increase in the 10-year. So when you start looking at these underlying pieces, they're like, okay, well, we need to bail them out. But to your point on monetary easing versus monetary tightening, it's like, all right, well, the BOE is still going to tighten. We still have to bring our balance sheet down. We're going to extend this olive branch to save you. And then on the fiscal side, we're going to issue the biggest tax cut since 1972. So it's like, okay, well, you're going to put more fiscal money into the system, which is going to increase inflation, but you want me to tighten, but I need to bail people out because they're too levered. How does this end? And that's where we continue to see this back and forth as they continue to fight on what's the best way forward.
Yeah, and by the way, just because, again, for us, it always comes back down to hilarious roads, we have suggested replacing the world central bankers with a squirrel who lives in my backyard who knows enough to collect nuts before winter. Just, it's really not that complicated, but they're trying to do everything all at once. Let's talk about the fuel market for a minute. So there's been talk about the United States not allowing exports of oil. All right, multiple choice question mark. Do you think it's a bad policy, a horrible policy, or the worst policy imaginable with disastrous consequences? A, B, or C?
Well, I would say D, but let's focus on the C.
Okay. Let's hear it.
So when you look at the structure, so we have a YouTube channel where we like to rant about this on a regular basis. So the U.S. structured their refining capacity to take the heavy sours, the Mayan crudes, Venezuelan crudes, Middle Eastern crudes that needed to be processed. So we did this on the Gulf Coast. Why not? It's the easiest way. We have port capacity. This is how we were going to structure things. And the last refiner was built and opened in 1978. It is currently 2022. Give you an idea of where we sit on how old these assets are. So now we have continued to bring these assets down. We've shuttered them. We've increased the shale capacity because the shale revolution happened. But shale crude is 42 to 48 API. The average refiner needs 34. So yes, we have this capacity, but it still needs to get exported. We don't have the capacity to run this, and we have to go to the international market to bring in that heavy sour. So who buys our crude? Our allies in Europe, our allies in Asia. So we're going to tell them that we're no longer going to allow them to get this oil that they need for their processing. We're going to hoard it into a system that can't actually run it. To do what? Exactly, outside of have a nice soundbite. Then you go to the diesel side, which is my absolute favorite. So when you look at the East Coast, and for those that live in New England, I hope you're buying Generacs that run on propane or something other than diesel. But we have the lowest amount of diesel in our history on the East Coast. And this is purely on a structural basis where, and if you remember in Philadelphia, there was a lot of fireworks in June of 2019 when the facility blew up. That took 460,000 barrels a day out of the market. So, okay, 2019 was a down year, 2020 was a fun year, 2021, you started to see the issues. Now, they're talking about, well, let's ban the export of diesel, right, or refined products. But it's all made in the Gulf of Mexico. There's two pipelines, and for those that remember, there was a hack that shut down both of those pipelines, and there was a massive panic. So now you have two pipelines that are fully tapped out. And I get these fun alerts of frozen transmissions, like we're not doing this, tapped. So as much diesel is already going from Pad 3, the Gulf of Mexico, up to the East Coast, where it terminates in Bayonne, New Jersey. But yet, the only other way to get it there is by boat. But we have a nice little fun thing called the Jones Act. The Jones Act means that you can only use a vessel that is built, manned, and flagged in the United States. Now, there are some very wealthy Connecticut individuals and family offices that happen to own those Jones Act vessels. So, right now, there's no way, mathematically speaking, to get that diesel from the Houston port up into New York. So, what do you do? Well, you, being good citizens of capitalism, we take that product, we sell it into Europe, take away some of that demand, and we reduce the overall price, or at least cap it, so that the East Coast can buy at some reasonable price. Now, if we were to get rid of and ban these exports, well, you're going to create a massive glut in the Gulf of Mexico with no way to effectively get it into the East Coast, while removing product from the global markets, which is going to increase prices and then therefore increase prices for the East Coast. So nobody wins except everybody loses, because Europe prices go up, our prices go up, and then the beauty of it all, we'll have massive gluts in Pad 3 or the Gulf of Mexico, and then you have economic run cuts, where these refiners will actually start cutting production because one, they're not making money, and two, storage is full. But yet, this is the policy being thrown out there.
Yeah, and I think the thing that a lot of people don't necessarily realize is, first of all, we're short refining capacity. That's the place we don't have enough. And so what Mark's really describing is a lot of stranded raw commodity that can't get to the markets it needs to get to. The other thing is, a lot of people think refining capacity is simply refining capacity. We bring the raw material there, they refine it, you end up with distillate, gasoline, diesel, whatever you need. But it's not. The refineries are designed to process a very specific grade of oil. And so it's not, the end product might be fungible, but it's not so simple to reroute all of this, and all we're gonna end up with is stranded product. Now, I know Mark and I, we talk about this stuff for hours in the course of a week. If anyone in the room has questions, we're happy to take questions from you guys. Yeah, what's the question?
I have two questions. We'll start with one. There's a view that the Fed is stuck, right? They can either kill the economy with monetary policy, bring down inflation, or they can leave it alone with the bond market to do the work for them. Powell's been pretty consistent about wanting to be Volcker and not Burns from the 70s.
Yeah.
And kill inflation. And then, you look at case history and, typically you need to move Fed funds above inflation for extended periods to actually have an effect. And monetary policy is a sledgehammer in trying to fix supply chain and wage issues. But here's the thing, the dollar today is a wrecking ball across the globe. Central banks are selling, government built securities to defend currencies. Who knows how big a problem this pension fund problem is. Mortgage rates in the U.S. just went over 7 over 30. Historically, the Fed is great until, they're very quickly not great. And we've had decade-long periods of kicking the can down the road. We've seen Japan blink, we've seen Bank of England blink. Isn't there the risk that, at some level of financial stress, they don't follow through and they do kind of go the birds around instead of Volcker up?
Yeah, I think first of all, it's a great question. First of all, Powell's been clear on this. It's amazing. If you listen to him speak, he says, I will let unemployment go up. I will let the economy suffer. I'm not like, we gotta kill this inflation thing or else. And he's been crystal clear on that. I also agree with the point that you just made, which is if he doesn't do it, the bond market will do it for us. The Fed governors have come out, they repeated the line from the 70s earlier this week, which is the dollar is not our problem, right? They're flat out telling you, we're not going to fix this for you. If our strong dollar creates a problem, we don't have to solve that. But here's the real fear on all of this, and this is what we were talking about before. Japan is failing. This is what we were texting and tweeting about at 3 a.m. last night. And there's a real possibility of a death spiral here. So basically where we are right now is as interest rates go up, the interest that we pay on the debt goes up, and it's going to take over a larger and larger and larger portion of our budget. Now, right now, we're printing a few $1 trillion a year just to keep things as they are. And so once people figure out, wait a minute, the only way we're going to make this work is to print. And the more you print, the more inflation you have, the more you have to raise rates, print again, right? I mean, at some point, the whole system fails. I think Powell, his policies have been ill-advised, but he's not a stupid man. He has to know that get this under control or you end in that death spiral.
And to that, I agree. I think the biggest issue for him is the wage spiral.
Yeah.
How do you avoid the wage spiral? Because that was really what took inflation to the next level, that got Volcker to go to 22 some odd percent. And if you listen to Volcker's comments back, looking backwards, his view could have done two different ways, which was go up faster, stop sooner, and then hold flat, or go up slower and then hold for a longer period of time and test how fast it could go. So his view, looking back, is he could have stopped at 17%, not going to 22%. And I think when you look at what Powell's talking about and when you look at what the terminal rate is going up to, we've talked about the terminal rate being 5%. I have actually won 4 free dinners and 5 free drinks because I said that the 10-year was going over 3% and that the terminal rate was going to hit over 5%. And I think that's what we're seeing is where he's going to try to get above to this level, maybe not go above inflation, but then just sit there and just hold in and let it actually filter through, because if they hold at that level, the bond market catches up, you start to see things come through, rates start to do its thing, and you go from this inversion to this steepener, and the steepener is going to be something that they're going to want to see into something a bit more natural, but it's going to be on the back of that inflationary side, which they want to see, where right now it's in a place that they're not comfortable with. And I think they want to really start to see that pivot. So if you're trading, I like the bear steepener. I think that's a good trade at this point.
You know, winning free dinners is great. We've been short the SPY all year. We've been short the QQQ all year. We've owned puts on the S&P 500. I'd rather do that and buy my own dinners. You can make money off of this nonsense too.
So it's been, but good.
I understand what you're saying about inflation and shortages. We can feel the loss of purchasing power. We can go to the supermarket, see the things that are missing. Cars now are taking something 6 months before they're delivered. So I understand those two things. I have less of a sense for the recession and the depression that you're talking about. So let's talk about depression. What are the chances that the United States is going to go into a depression, and when? And by depression, do you mean like the 1930s depression, the Venezuela depression, where people are going to be standing in line for bread and toilet paper? Or what do you mean by depression in this country? And again, what do you think the odds are?
I'm actually going to redirect that or reframe it. I think the issue we have right now is stagflation, right? We have negative GDP growth. We have insane, I've said that the real inflation rate is in the mid-teens. I think Mark thinks it's higher than I do, which is
16.75%.
All right, so I was at 15. So you've got insanely high inflation. And here's, again, I was saying earlier that people think that the numbers from the government represent reality. They do not. They are numbers that are derived by the government to advance a narrative. And the reason I'm pointing that out is here's how they manipulate GDP. With the GDP calculation, there is an inflation adjustment to that. And it makes sense. You would adjust for that. But they're using the CPI as the adjustment. And the CPI is understated by roughly 100%. Right? So we're looking at GDP growth of negative 1%, or some people say, hey, that's not really so bad. But when you adjust for the real inflation rate, we've got GDP of -7, -8, -9%, with inflation around 15%. The situation we have right now is stagflation.
And so when you talk about depression, I'm going to say that no to a depression. And the only reason why is when you look at the 1930s, you had Ellis Island, you had a demographic shift. You had a huge inflow of people that were coming to this country from the 1860s in terms of the Irish potato famine all the way through the 30s. So you had this huge influx of cheap labor that was trying to come to this country, creating this huge shift. Now, what do you have? You actually have a falling participation rate. You have a demographic shift that is getting older and not enough people to come in and fill these jobs. So like when we were joking, because the JOLTS data came out, which is the job openings data, and the market rallied 100 handles because job openings are falling. It's like, you can't fill the jobs we currently have because there's such a low participation rate. So I think the likelihood of a depression is very limited. I think it's more of we're in a recession at this point. The consumer is now struggling. I love how there was an Excel error and that they overstated savings savings in the bank by 350 billion. I know, small number. And you start looking at the consumer and the consumer spending power. And I think you're going to see that consolidation and you're going to see that pivot where people just aren't going to spend. And it's under the guise of this stagflation where everyone's picking this pivot. And it's like, well, what if we just don't go anywhere? If we just kind of sit here and you get this weird conundrum of, well, you didn't do any R&D. You just did a swap, equity for debt. So you have companies that are now sitting on all this debt. They're not going to hire anyone. They're really not going to try to invent anything. They're going to go sideways. You have all these zombie companies that need to go bankrupt. And I think the bankruptcies of the zombie companies would start to see more of that pressure on that recessionary pullback.
So I just want to be clear, I'm sorry. So despite all the gloom and doom we're talking about, inflation, shortages, stagflation, you see a floor to the misery. You don't see it going beyond the recession.
So the beauty of the dollar is that we're still the reserve currency of the world. We still have the backdrop of that, and everyone else is doing worse than the US. It's nice to be the prettiest house on an ugly block. And that's where we have this ability right now to continue to protect that. The question is, as we continue to keep rates where they are, do we import a recession? And that's when you start looking at what's happening in Europe, what's happening in Asia. When does that start to hit home? And I think that's when you get the bigger drop because the consumer's fickle. Like I've been saying that that real retail sales were going to drop, that the consumer was going to backdrop. Instead, 24% APR apparently didn't stop anyone because we have a record amount of credit card debt. But that's going to hinder growth. And I think that's when you get that stagflation. It's, does GDP really drop 7%? Or do we just kind of bump along at -2% for 3 years because we don't have any real growth?
So, Mark, I think you're right. But if you were wrong, here's what it would look like. One of the reasons the U.S. is the dollar is the world's reserve currency is because of the petrodollar, right? Kissinger struck the deal with the Saudis and said, we're going to provide you military protection, but you have to agree that all oil will be denominated in dollars. And that's the deal that we've had. It's the petrodollar, and it's been a huge factor in the dollar being strong because it's created worldwide demand for dollars. Literally every country in the world needs to have dollars in order to buy oil. Well, relations with Saudi Arabia are not so good. Congressional Democrats are openly talking about pulling the military out. Wait a minute, that breaks the petrodollar. The Saudis are openly negotiating with the Chinese to sell their oil in yuan or renminbi Russia succeeded. They put a gun to Europe's head. They said, you want oil? Pay us in rubles, gold, or Bitcoin. It's not dollars, not euros. That's what they said. And Europe said, no, we have a contract. And Russia said, no. And Europe caved, and they've been paying in rubles. So we're seeing this situation. It's not clear to me the dollar is going to remain the world's reserve currency. And the other threat to it, and I promise BJ's giving me the look there.
One question.
Okay. But if any of you have heard about like BRICS, this other coalition, they're trying to put together an alternate to the dollar as the reserve currency. And you think, okay, well, wait a minute. So put the ruble and the yuan against the dollar. We're strong. We can come out. We've got more economic power than they do. Except, here's what they're talking about doing. They're talking about backing it with hard commodities. And guess what they have? They have gold. They have oil. They have gas. They have fertilizer. Wow. Copper. China has a monopoly on rare earths. They've got a huge amount of lithium production. They can back this dollar competitor with real commodities. And that's a game changer. And so I don't think you're wrong, Mark, but if you are, that's what it looks like. Yeah,
So Kathy Woods, Elon Musk, and Jeff Gundlach have all talked about how a major Fed hike risks deflation. Can you talk about the risks of deflation happening next and whether you think that's a possibility?
I just want to know, does anyone here consider the possibility that Kathy Wood may be just talking her book? She had great performance when rates were zero, quantitative easing infinity, and the companies she owned were ultra high growth, cash flow way in the future companies. Her performance has been horrendous. Maybe she's right, but I don't know. I also think her argument's disingenuous. One, because I think she's talking her book, but two, I think her math is dishonest. And what I mean by that is, I read the letter. She wrote an open letter to the Fed where she talked about this incredible increase in interest rates 12 times. Rates are up 12x what they were. That's outrageous. Imagine you go to the grocery store. You were there last week, it was $100. You go this week, it's $1,200. You'd be angry, right? Your rent is $1,000 a month. You go next month, they say $12,000. This is ridiculous. 12 times, that's a big number. But here's what really happened. Rates went from 25 basis points to 3%. Yeah, okay, so the math is right. If it's 3% with headline inflation at 8, real inflation at 15, rates are negative. The Fed still has a balance sheet that rounds to $9 trillion, including trillions of dollars of mortgage-backed securities they're not allowed to own. I think it's disingenuous of her to say rates are up 12x, this is outrageous. No, a 3% Fed funds rate with inflation over 8 it's not only reasonable, it's dovish. So I just don't agree with this idea that the Fed is going to crash the economy. I think the damage was done over 12 years of 0% rates and a $9 trillion balance sheet. I think that was really the issue.
So can you talk about the mortgage-backed securities? Are those things they bought in 2008, and where are they going to sell them if they're illegal?
So at this point, but just on the deflation side, so I actually do think we can get deflation, and I don't think it's a bad thing if you look at where we've gone to. And if you look at deflation, so I had posed the question of, would you prefer 5 years of high inflation or 2 years of deflation? And if you look at 2 years of deflation in terms of bringing asset prices back into a place where people can actually afford things again, is that really a terrible thing? And is the deflation going to be built on, the cheapening of labor, the cheapening of goods? And I think in terms of where we've gone, we do need some of that coming through. Now, on the underlying piece of mortgage-backed securities, they issued this because there was a concern about liquidity in the mortgage market in terms of trying to protect these banks that were sitting on a plethora of mortgage-backed securities because they saw what happened in 2008, and they wanted to get in front of that in terms of making sure that there was enough liquidity, which is fine. If you go back to March of 2020, Do I think they did the wrong thing? I mean, I think there were several very large people that were insolvent that make the long-term capital management situation look like child's play. But it wasn't a bad thing to do the liquidity point. The issue is, why did you do it all through 2021?
Right.
Like, what was the benefit at that point? You had provided your liquidity, but you wanted to keep this pushing forward, you wanted to do this, and I think that is where you take a step back and it's like, all right, well, who are you selling this to now? Like, why, at this point, shouldn't you just sit on it and just let it go through? Because it's golden handcuffs. Most people who bought homes at 2%, yeah, you paid over 30%, but if you're not moving for 25 years, is it really that bad? So if you try to liquidate, it is, which is why, like, we call them golden handcuffs. Because now you're gonna have to sit in that home, pay down that equity to get to a point that makes sense. So if it's 2% paper, but then if you mark to market the Fed and their balance sheet, well, they're actually losing money. And that's where you start to get some of this concern on their balance sheet.
Yeah.
I just wanted to, talk about the disaster scenario. I think 3/4 of U.S. oil production is shale, or 2/3 now. Obviously, that goes into shale boom. Shale wells have a depletion curve in the first year of 60 to 70%. In 2019, our firm did a survey of the U.S. industry, and about 46, 47% of operating shale wells are first-year wells. We've had underinvestment for 2 years. So we've got a majority of our production underinvestment, not able to keep pace. Past 12 months, rig count in the U.S. is down at 50%. I know you have to adjust because of delinking horizontal drilling and stuff, but oil production in the U.S. is up mid-single, high single digits. Isn't that the risk that we kind of dialed in really ugly supply numbers, production numbers in the U.S. over the next 2 years? Russia's eastern fields are going to see declining production at lack of access to Western technology. And OPEC, we can debate what the real spare capacity is, but it's clear they've underinvested and they've missed quotas for the past year. So people talk about the shale cliff, but isn't that a disaster if you see oil at 150, 200? So I know it seems crazy now, but people say, high commodity prices are the cure to high commodity prices. That fails when there's structural supply problems.
So not only do I think OPEC is tapped out, and I don't think the Saudis, they say we have excess capacity of this, but we'll give you this. They don't have this. But the other thing is and I don't know how you prove this, maybe you know, there are rumors that the Saudis have been tapping their version of the SPR, their Strategic Petroleum Reserve, and some of their production is not actually production, but sales out of inventory. Have you read that?
So
I don't know how you prove it.
Well, so they have storage around the world that they rent, and they rent from, and it's a way where it's not filed under the Saudis, it's filed under the local country. And the issue was, when you look at 2014 to 2016, during the OPEC price war, you had this massive run-up in production, but you had to put it somewhere. So they were storing it pretty much under any rock they could find, and they had to bring that back down and normalize it. When you start looking at where production is going from here, the question is a mixture of, do you have oil, but do you have the right type of oil for what's the actual refining capacity? And that's when you start looking at the U.S. So I actually work with Primary Vision, where we do frac spreads. So we look at completion crews. And the problem is, we've kind of come to a point where 12.7 million barrels a day is really our peak. And we're not going above that. The question is, can we pivot far enough? And if you listen to what the politicians say, for the last 10 years, it's natural gas the bridge fuel. Now it's just natural gas. And it's because they've recognized that natural gas and natural gas liquids is the new future. And if you look at the stranded gas assets, there's a plethora of them. So when you start looking at the oil decline, the answer is yes, it's real, it's there. But can we replace it with natural gas and natural gas liquids fast enough to help offset that? Now, based on policy, the answer is no. And that's where you've seen this steady decline.
What oil price or what gas price or blend energy? I'm using oil because it's a simple price to follow, but what price gives you the depression scenario?
So if you look at Brent, so if you take Brent, if you have Brent at $175, $200, you have emerging markets that are imploding. And that's when you have that structural issue, because we talked about diesel shortages in the US. There's a distillate shortage around the world. This is not just the US. Singapore is at an all-time low in terms of their stores. Fujairah is at an all-time low. You know, when you look to Europe is an all-time low. So it's a knock-on effect, and a lot of distillate goes into electrical production in Central Asia. Well, if you can't get distillate, what are you going to get? You're going to go run resid. You're going to go run heavy sulfur fuel oil. So now you're trying to bring down the green dream. You're trying to bring the green dream, but all of these countries are now just burning anything they can get their hands on to run it through, which is high sulfur. So what we should be doing is focusing on bringing that natural gas production online. And when you look at the current spread of $5 to $6 Henry Hub, $30 LNG, there isn't a project out there that isn't in the money. And now you look, like even Lebanon made a deal with Israel. Why? Because there's a lot of gas right there. And Lebanon, trying to kick out the Houthis and making that change on their structure, are recognizing, I need to team up with the Israelis to do this. And if you look, India, UAE, Israel have now created this natural hub to counter some of the growth of China and Saudi Arabia within the GCC.
We hit that spot this summer though, because we got to 126 on Brent, but crack spread went from 20 historically to 50, 60. So the retail equivalent was what you were talking about.
So when you look at Brent, you had the SPR release. So when you look at the SPR being pushed into the market, you were able to bring down. So the problem is time spreads blew out. So when you push the SPR into the market, that was able to bring time spreads back down. And then you had China going into massive lockdowns, and their purchasing went from 17 million barrels to 13 million barrels. So all of a sudden you had a delta on what China was importing. You had an SPR release, and all of a sudden you had a market that was balancing out, and now you actually started to see an increase, which was able to bring prices back into these levels.